Welcome to all of you. I am Dr. Sanjib Pattnaik. Again, I welcome all to our this particular session that we shall be having over the next 1 hour period, which is a part of your course called as equity markets. It has been coded as MMPF 007. Now, in this particular course, equity markets, we have seen the general market in the Indian economy, that is the capital market and the money market also, or in other words, the primary market or the secondary market. The various regulators we have seen, instruments we have seen, then we have seen how one can judge about a particular security. Now, when we are judging about a particular security, we are looking at two important characteristics, that are the risk and the return. Now, when we are talking of risk, we are talking of whether the return that we are expecting out of the security is going to happen or it will be less than that. Similarly, once we knew what are the individual risk and return of a security, we tried to construct a portfolio because, as the saying goes on, we don't put all eggs in a single basket. Now, when you are talking of why we shall not put it, think of a scenario. Suppose I have got some eggs and I put in a single bag, carry bag, and I am taking it home. If it breaks or falls down the bag, then what will happen? All the eggs will be broken. So, if I put all my funds or investable funds in a particular security, then if the security faces losses, that loss will be also my loss. I cannot survive of, or in other words, I cannot avoid that kind of loss. But let us change our the viewpoint. Let us put all the eggs in different places. Suppose in the bag we have two eggs. If the bag breaks or falls down, only two eggs will be lost, but other will remain intact. Or, in other words, if I spread my investable funds in various securities, then the collection of security where I put my fund is called as the portfolio. I do that because any loss arising out of investment in a single security may be offset by the returns or positive returns or profits generated in other securities. So, thereby I can reduce my risk. So, we went to see the risk and return characteristics of both individual security as well as the portfolio. Now, once we could create the portfolio, then we saw how we can get the best for portfolio for us by use of the efficient frontier and the indifference curves. That means which portfolio satisfies our expected return along with the risk involved. Then we went on to see uh, particularly the various type of instruments that are available to us, then the regulatory authorities, and how to know whether a security is good or bad, that means fundamental analysis, how to determine the timing of transaction, that is buying or selling of securities, that is technical analysis, whereby we used various kind of charts, graphs, oscillators, etc. So in today's session we shall see a special item involved in the markets, that are mutual funds and alternative investment. When we say markets, generally two things come to our mind. Markets deal with assets or securities which are basically, suppose, the market I am talking of. Market, I can say it consists of mainly equity and debt. Now, this equity and debt, they have their own characteristics, own returns with return and risk characteristics. Apart from that, are there any other alternatives? Or why should anyone think of another alternative? Now, let us think equity share. Suppose a equity share of a big profitable company is selling for rupees 4,000 each in market. Now, I being a small time investor, I will be having some limited funds. Now, when I purchase the securities, I have to purchase them in lots usually. Or my investment amount, since I am a small time investor, may not be sufficient. Suppose I represent as I1 and it is not sufficient to have this 4,000. What happens? Suppose I join this investment with another investment party called as I2. Thereby, it may be possible to invest rupees 4,000 in that particular security, which is having or commanding a high value in the marketplace. Now, this combination of investable funds in the hand of small time investors or households is called as, the process is called as pooling of funds. Now, who does this? Now, a organization or a institution called as mutual fund. So, mutual fund, they pool together the investment amounts of small time investors or households whose investable amount is very small to participate in the high priced securities purchase and selling. What we do, we generally give our funds to mutual fund through certain units. That means I purchase shares of mutual fund called as units with my amount. whatever is my respective amount, that many units I shall be getting. Now, the fund that is collected by the mutual fund will be invested in the market. And whatever returns come out of this, mutual fund keeps its charges, and other thing, they give us the income to unit holders. So mutual funds are institutions which pool the small investable amounts of small time investors as well as households, so that a large collection of funds will be there and can be invested in the very high price securities or high price debt instruments available in the market, thereby allowing the small time investors or the households to participate in these high price securities as a part owner. They become the part owner or proportionate owner. So, in this particular session, we shall see what are these mutual funds, what are the schemes available, and what are the alternative investments apart from mutual funds as an alternative to debt and equity investment. As we have seen, mutual funds form an important segment of the financial system, because apart from equity and debt securities, where all investors cannot participate easily, it forms a avenue for small time investors and households to participate in the market through the units of mutual funds. What is the basic activity they do? The mutual funds, now they mobilize savings. They mobilize or collect from small and household sectors the funds that will be invested in capital and money market instruments, which otherwise would not have been possible by small investors or the household sectors. These funds are mobilized by mutual fund through certain instruments called as units. The shares of the mutual funds are called as units. So anyone can purchase the units, and according to their proportionate value in the total of the funds, they are the part owners of the invested amount in the highly demanded securities or high price securities, etc. Each unit represents, as we have just now discussed, a part share in many securities purchased by mutual funds. So, mutual funds do not focus on a single security, but they create different portfolios. And according to the choice of the investor can purchase the units based on that particular portfolio, which matches to his own requirements. It provides the convenience and satisfaction of owning shares in many industries. Now, with small amount of investment or surplus money in the hand of small time investor or the household, we cannot purchase lots of different securities. That means we cannot create a very big portfolio, diversified portfolio, or enjoy the returns of the big or the profitable companies, since our investable amount is very small. We may stop at one or two companies when our investment gets over. But if we purchase the units of mutual fund, it allows us to participate as a part owner in the various companies in which the huge amount pulled together by mutual fund through units are invested. They act as intermediaries, the middleman, between what? Another small time investor or the household sectors mainly, and the funds that has been pooled together are invested in different securities. Now, when the returns are generated from those securities, they are given as dividends to the individual unit holders. Now, India saw the advent of mutual funds, or mutual funds were introduced in India by UTI in 1964. Now, once we know what is the basic logic behind the creation of mutual fund, whom it helps, how it helps, as we have seen just now, we shall go on now to see what are the various type of mutual fund schemes available in front of an investor to choose from. So, first is based on organizational structure or organization structure. There we can have three types: open ended, closed ended, and interval funds. Now, what is a open ended fund? Now, suppose a mutual fund comes up with a scheme on 1st February 2026. And the timeline goes on. Now, anyone can purchase the units at any point of time, or they can, this is buy, sell units at any point of time. There is no deadline that how many units will be sold or at what date the units will be closed for selling to the unit holders. Opposite to that is closed ended. Let us take another example. 1st February, a mutual fund comes up with a scheme and says that if you want to purchase within 1 month period. Thereafter, no selling of units by the mutual fund will be done to the investor. And this particular units that has been sold to the investors, they will be held by the mutual funds. They cannot liquidate directly with the mutual funds. That means they cannot sell back their units to the mutual fund and get their funds, which was happening in open ended. Now, in this case, what happens? Suppose somebody wants liquidity or wants to convert their units they have already purchased into the cash needs of their own. What they will do? They will go to the stock exchange where this particular scheme of mutual fund has been listed, and they will try to sell it off in the stock exchange. So these are closed ended. Once the sell closure comes of the units, then no further selling of units will be done. And at maturity, they can get back the money, or they can trade their units for liquidity in the listed stock exchange. That means wherever the mutual fund is listed. Interval funds. Suppose that particular security whoever purchases in the purchase period, suppose 10th February, there will be a lockdown. Suppose this lockup period is usually it is for 3 years or 5 years lockup period. That means you cannot buy or sell the units of the mutual fund within this particular period. Just like closed ended the units of mutual funds. After that, you can buy or sell the mutual fund units, or in other words, you can redeem the mutual funds. That means the first portion looks like close ended, second portion looks like open ended. So, for an interval, the mutual fund units are in a lockup period. So, these are according to organization structure of the various schemes. We can have open ended scheme, closed ended scheme, or the interval funds scheme. Now, second mutual fund schemes categorization that we can have is based on investment objectives. When we are talking of investment objectives, investor usually either look for capital gains or income yields. Capital gains, if I hold the units for a fair length of time, then due to change in price, I will get the capital gains. Income yields will come from the various interest or dividend payments that arises out of the invested securities. Now, usually what happens? The investor either they try for capital gains or try for the income yields. That is investor's choice. Now, these capital gains are called as growth funds, and these are called as the income funds. Income funds. Now, when we are having growth funds, again we have different categorization of the growth funds. Now, what are the categorization? First is diversification. That means you diversify your the pooled amount of the mutual fund uh, according to the various sectors in the economy. You spread your investment. Another is growth fund. You invest in equity share which are sector specific. Suppose iron and steel industry. Suppose the cement industry. Suppose the aviation industry, like this. Another is tax saving funds. Now, when you invest for a period of time, there are certain exemptions allowed under the taxation system of our country. And the last one is index based funds. Now, the funds which are constructed according to the proportion of the securities as they are present in the stock index, that are called as index based funds. The second category are the investors who depend upon regular income from their funds because they are always in need. The big or the rich individuals, they usually go for capital gains. Now, income funds, when we are talking of the pooled amount, may be invested by the mutual fund in gilt securities, government securities, short term government securities we call as gilt edged securities or government short term securities. Corporate debentures, which have a maturity of 5 years, 7 years, like this, long term, but they will give you regular income. Government securities or government debt securities, they will give you regular income, and at maturity they will return back the funds. Similarly, a mixture of equity and debt. Now, certain portion is invested in equity in order to have the capital gain portion. Remaining portion or majority is invested in debt securities, which will be generating a regular income for the investor. Another income fund is money market funds. Money market is that place or market where securities having a maturity of up to 1 year period are traded. So these money market funds are included also in income funds. Then, based on portfolio management, usually mutual funds, as we move on, we shall see, mutual funds are managed by various experts or portfolio managers who have expertise in this particular sector of financial transactions. So when it is active fund, then what will be happening? The managers or the management team of the funds will always be lookout on the amount of investment, how it can be raised further, the return can be enhanced, how losses can be minimized. That means they keep a constant supervision over the invested amount out of the pooled funds. Similarly, you have passive fund also. What are passive funds? Now here the management does not take much of the decision. They only do what? They try to invest in that proportion, as is the case of certain index where the mutual fund is listed. Suppose in Bombay Stock Exchange, a particular mutual fund is listed. So, whatever is the Sensex constituent proportions, on that basis, the mutual fund will be purchasing securities of those companies, just like a miniature index. So, their constant supervision is not required. Any changes in the stock market index will only allow you to make changes. So it is a dormant or passive style of portfolio management, or we call the funds or the schemes as portfolio passive funds. Another is geographic location, where from you are generating the funds. That means whether it is from the Indian geographical region or from outside India also. If it is within our country, then it is domestic funds. If it is from outside countries, then it is offshore funds. So according to the need, we go for various type of schemes. Now, the mutual funds are regulated by SEBI, Securities and Exchange Board of India. According to SEBI's categorization, the various mutual fund schemes, let us look at. First is equity schemes. Name itself is saying most of the investment of the pooled amount under the scheme will be invested in equities. First is the multi-capitalization. Cap means multi-capitalization companies. So when you are investing in various type of capitalization of the companies, then at least in one capitalization sector, you have to invest 75% of the pool funds. Second is flexible capitalization. That means what? You can change your proportions when the need arises, but investment in a particular scheme out of any number of investment should be not less than 65%. Remaining 35% or less can be invested in other capitalization companies. Large capitalization company. The name itself says the companies with huge market value. So there the mutual funds can invest their funds in their equities, whereby at least 80% should be invested in large capitalization companies. Remaining 20% you can invest elsewhere. Similarly, large and mid cap equity scheme. So here any number of categories of capitalization you take, but in large capitalization sector or the mid capitalization segment, you have to invest at least 35% each of the categories. Remaining 30% or less, you try to invest in other avenues. Similarly, in large cap, we have seen 80% to be invested. In mid cap or middle capitalization organization, the amount to be invested under a equity scheme is not less than 65% in mid cap investment. Also, we have small capitalization scheme. When the scheme is named as small capitalization, then what happens? At least 65% of the total funds generated under the scheme should be invested in the short term instruments. That means small capitalization should not less than be 65%. Another one is sectoral fund. Suppose out of the various sectors, I choose iron and steel sector, iron and steel equity scheme. So what I will do? I have to go for equity share of this particular sector of the economy. So the sectoral funds should be allocating the funds not less than 80% to have the fund or the scheme going on. Similarly, SEBI also has categorized the debt schemes. That means whereby you are having the debt instruments or investment in debt instruments, the pool funds will be invested. If it is debt scheme, first one that we see is overnight fund. Immediately, once you look at overnight, that means a 1 day period. That is why I have written maturity less than 2 days. The fund will redeem. Similarly, liquid funds. That means the scheme will try to invest in those instruments or those debt instruments whose maturity are less than 92 days. Similarly, ultra short duration fund. When we are talking of ultrasound, then we are talking of instruments having a duration of 3 to 6 months periods. Money market funds or money market debt schemes. The funds collected under this particular scheme, money market funds, are invested in securities where the time period of maturity is maximum up to less than 1 year. So up to 1 year, the investment amount is invested. Short duration fund. If the investment securities are having a duration of 1 to 3 years, we call it as short duration. If the duration is between 3 to 4 years, those are called as medium duration fund. Similarly, if the maturity is 4 to 7 year period, we try to issue debt schemes which are medium to long duration fund. And what are long duration fund? Any mutual fund scheme which will be investing in securities having a maturity of not less than 7 years or maturity greater than 7 years. Similarly, you can have dynamic fund, any duration you can take here. Corporate bond fund. Corporate bonds are debt or the debt instruments. If you want to go for corporate bond funding, 80% of your funding needs to come from the investor side to be invested in the corporate bonds. Similarly, you can have banking and public sector units fund. So in this type of debt scheme, the fund amount at least 80% should be invested in the banking and PSU fund. Now, after looking at the equity schemes, the debt schemes, now we look at combination of both hybrid schemes. First one that we shall be looking at is conservative hybrid fund. Now in this, the name or the catchword is conservative. So that means they do not want to take much of the risk. They are happy with their stable income. So what we can say here, conservative hybrid funds, the investment amount should be at least 10 to 25%. Balanced hybrid funds. Here we try to uh, balance the equity and debt investment from the funds. That means they are more or less near to 50%. So here the investment in equity is between 40 to 60% and remaining are on the debt instruments. Aggressive hybrid fund. Aggressive means you are going to take more amount of risk. More risk means more investment in equity shares. Look at the investment in equity. It should be 65% to 80% of the fund should be invested in equity, the securities. Dynamic asset allocation fund. So here, any changes in the market, the management of the mutual fund should immediately be taking action on that. They are very dynamic, or in other words, their response to the changings in the surroundings of the marketplace is very fast. They are very dynamic. Similarly, you have multi-asset allocation fund. When you are talking of multi-asset, you can talk of equity asset, you can talk of debt asset, or equity and debt as securities. You can have precious metals, you can have agricultural products, etc. So, in multi-asset allocation fund, the amount pulled together is to be invested in at least three asset classes, and each asset class, that means this particular three at least, should be having at least 10% investment of the total fund in each. Another one is arbitrage fund, where the amount of investment in equity is 65%. Similarly, SEBI's mutual funds, the schemes are also there for solution oriented. That means they provide certain kind of solution for, let us look at the first one, the retirement fund. After retirement, we may be getting pension or not getting pension. We are no longer getting the amount of income or salary that we have got from the working days. So what happens? In order to support us, support our lifestyle, support the sustenance, we require funds apart from Suppose post retirement benefits which are very negligible. Now, this fund will provide us adequate returns so as to spend our remaining life after the retirement. So, here, once invested in the scheme, the lock in period is for at least 5 years or retirement, whichever comes last. So lock-in period is for 5 years or till retirement, whichever comes earlier. Similarly, you can have children's fund. We try to invest for children's future. There also the lock-in period is at least 5 or till the child gets the majority age or becomes a major in terms of age. Then you also have other schemes like index funds. What happens in index fund? Your pooled amount of the scheme, at least 95% is invested in those securities that have been included in the index and in the same proportion as the index has been constructed. Another type of scheme is fund of funds. Instead of directly investing our funds as mutual fund in certain securities or avenues, what we do? We invest in certain other schemes of another mutual fund. That means you are using the fund of a mutual fund in funding the funds of another mutual fund. So the name comes fund of funds, whereby at least 95% of the funds of the mutual fund should be invested in the other mutual funds, the investment scheme. Now, the mutual fund structure in India, how mutual fund is working. The mutual fund is regulated by Securities and Exchange Board of India. The business is regulated. All mutual funds have to be or should be registered with the SEBI. Any person or entity, that means any organization, can act as a sponsor to set up a mutual fund like a promoter. When setting up industries, etc., promoter is the person or the entity which sets up the industry in the initial stage by paying the amount from their own pockets. Now, once a sponsor is there to set up the mutual fund, what the sponsor will do? It will ask SEBI that you please grant us permission to set up a mutual fund company so that we can set up the mutual fund. So here SEBI will try to assess whether the sponsor is following all terms and conditions, and if it is found okay, then SEBI agrees to the inception. Once SEBI agrees, a public trust is formed under the Indian Trust Act 1882. The public trust is registered with SEBI. So first, sponsor takes the permission. If SEBI agrees, a public trust is formed which has to be registered with SEBI. Now this public trust has to be run by various trustees who need to be registered with SEBI and they are appointed to manage the trust. The basic function of the trustees are to protect the unit holder's interest and comply with SEBI regulations. Now, once this is done, then the asset management company AMC is created by the sponsor to regulate and manage the funds. Now, once the sponsor set up the asset management company, that is the mutual fund, who are the other players that come into the picture? We have first is custodian. The name itself speaks that the custodian will be safeguarding certain things. So, custodian here holds the securities purchased by the asset management company or AMC. These custodian are responsible for safekeeping the records for the AMC. They will keep the records. The delivery and transfer of securities are managed by the custodian. It is not the AMC which will keep the will take the task of delivering and transferring the securities. Here, the custodian cannot or do not make any recommendations to the asset management company that this securities need to be purchased, this security needs to be liquidated. No, no recommendations will be undertaken. Similarly, custodian cannot initiate buy or sell assets on behalf of AMC. They cannot do that. Once they have the authorization from the AMC, then only they can buy or sell. Their functions are limited to back office operations like record keeping, like delivery and transfer of securities, etc. Second player that comes into the picture, one of the important one, are the registrar and transfer agent, RTA. Now, the individual investors and the asset management company, they need a bridge to be linked. That means they have to have a link between themselves. Investor is investing in the AMC's schemes. They may be having some kind of problems, some kind of queries or questions which has to be taken up by AMC. Who does that? Now, somebody called as RTA, Registrar and Transfer Agent, which acts or serves as a link between these two. Now, what does RTA does? It maintains records of the investors, including folio, number of units, scheme details, history of transactions, contact details, and know your customers or KYC. So every investor of the scheme records has to be maintained by RTA. So according to the scheme, respective investors' information will be kept along with how many security units they have purchased, what are the details of the schemes that has been promised when the schemes were floated, and what is the history of transaction, etc. Now, they also send account statements and periodic statement to the investor, either in printed form or in electronic format. And in case returns in the form of dividends are declared, then investors are intimated by the RTA. They are given information on the dividends. Here, RTA also performs another major task, that is, they maintain the list of investors at the end of each day, which includes additions and deletions during the day. Because investors will be either purchasing or selling of the units. Thereby, there will be additions and deletions of investors each day. Another player are mutual fund distributors, MFD. Now, these are the link between retail investor and the mutual fund. Now, retail investors are the big financial institutions which have lot of money from various sources to be invested. So, mutual funds also tap this kind of institution for collection of funds to various schemes. So, mutual fund distributors, they recommend mutual funds to their clients. That means the retail investors. And they not only recommend but also tries to apprise them, make them conquer or ensure its success. And mutual funds pay commission to this mutual fund distributors if they are getting successful. Now, all the transactions need to be verified or audited, for which auditors are appointed who check the records of mutual fund for correctness. The last player that we can talk about is stock brokers. Now, mutual fund schemes, once they collect the funds, it is not the asset management company who can directly go to the stock exchange and invest the funds. They have to take the help of the various stock brokers. So, stock brokers act as a link between mutual funds and the stock market. Apart from that, stock brokers also issue research report which are used by asset management companies as a part of due diligence. What are the advantages of mutual funds? First of all, the mutual funds have under its ambit of management various experts in the field, so professional management. With huge amount of funds collected under a scheme, they can well diversify into various securities, which could not have been done by individual investor. These are well regulated by SEBI, easily liquidated, the amount of risk is less as it is properly managed, and flexibility is there. The mutual funds can change their investment amount from one sector to other like this, and due to huge fund investment at a point of time, they face the economy of scale, that is lower transaction costs, and also investor have less stress. When we are talking of disadvantages, then we are talking of the cost of managing the funds. And most mutual funds put a exit load. That means when an investor sells up the units, they are charged a exit load and dilution of information. And mutual fund investments can be either regular or direct plans where no distributors are involved. We can either involve lump sum payment to the mutual fund, that means a once payment, or systematic investment plan. Regular periodic payments we shall make. When you are having alternative investment funds, you can have hedge funds, private equity, real estate, venture capital, which all are regulated by SEBI. And these have long term investment horizon. When you are looking at alternative investment, you are talking of, suppose, hedge funds. That means high risk, high return funds. Venture funds, new ideas have to be funded. If they click in the market, they will give you huge return. But for that, investment has to be done, which can be done from mutual fund schemes. So these are all the discussion regarding mutual fund and alternative investment. Thank you.